All right, let's get started with the first conversation of the day. And this is a segment that we like to call Meet Your Fund Manager. And the reason why we enjoy doing this segment and we think it's very important is that when you're out looking for funds to invest in, actively managed funds to invest in, the proclivity is to usually look at a peer comparison over the last 12 years or even the last 3 years and 5 years. You might even do a rolling return comparison. You could look at certain other metrics, but I think that the most important thing to look at is the philosophy of the fund manager and the fund house and how that gels with what your own expectations are. In that context, we are going to be speaking with Vinit Sambre, Head of Equities at DSP Mutual Fund. Thank you so much, Vinit, for taking the time.
Thank you, Alex, and thanks for inviting me on the show. Very happy to be here.
Absolutely. I'll start with the first question because I think a lot of your investors and your prospective investors would benefit from this. What is the philosophy that you followed, that you have followed in the career that has now spent so many years now? And what is the philosophy of DSP when it comes to actively managed equity funds?
Yeah, thank you, and let me just wish all my investors a warm, good wishes to them. And just to talk about the philosophy, as far as I'm concerned, we have very clearly articulated our thought process as well. So in terms of the most important aspect is to think investors to think long term. One needs to check, do we also behave in the same manner? So when we look at our own funds, when we look at our own stock selection, the period for which the stock stays in the fund, I think our turnover ratios for the funds which I have been looking at has been pretty low, which means that we have followed a very long-term approach of looking at companies and businesses because, my belief has been that the companies and businesses take time to grow and flourish, and it is towards the latter part of their cycle when things keep becoming better and better, unless the businesses are getting disrupted or there are some other risks which are emerging. So I think the first point is that as a philosophy we have looked at the long term when it comes to investment into the companies. The second aspect is that what type of companies do we look at? So clearly, when we are having a long-term view, we need to identify companies which will be able to outgrow their category over a long period of time. And for that, we keep looking at the unique value proposition which the company brings in, what we call as moats. And we take a lot of time in understanding the key strength and the USP of these companies and whether they will be able to sustain those for a long period of time. And once we are able to identify those, I think those are the companies which basically comes into our basket of evaluation. And then, we look at the long history of these companies, let's say 10, 15 years, how the company has delivered in terms of the growth, in terms of the cash flow metrics. How does the management think about the balance sheet and the capital efficiency? So, we look at ROC, ROEs of these companies, and all in all, once we have a very good, strong view about the company, we believe that this company will be able to hold on for a long period of time and the company will create wealth for our investors. That's the point when we start, investing into that company. So that's the broader few aspects of the core philosophy which we have followed.
Okay, fantastic. That kind of gives us a picture as to how you approach things. But how do you see the current context, Vinit? On the one hand, you're talking about several companies here in India, several sectors that have weathered the storm of the pandemic, and now the prospects are looking better. You're talking about pent-up demand in quite a few sectors that is expected to come to play in FY23. At the same time, there's a great degree of uncertainty because of what is panning out the world over in terms of how stock markets themselves will work. And there's also, for the manufacturing companies, the whole cost pressure thing, which a lot of them have not been able to contend with. They've not been able to pass it on to their consumers, and therefore EBITDA margins are shrinking. So how's the earnings picture looking?
Yeah. So see, in the context of how the overall investments has to be looked at, I would first like to qualify, before I share my thoughts on your question, that investment has to be with a long time horizon, and whatever I'm going to say is taking that as a base case, and give my views. So see, time and again it has been proven that equity market has always uncertainties has always been a core part of the equities, and equity market has weathered even bigger issues and problems in the past, and we have seen that markets have emerged better. Good companies have outgrown the markets, and they have delivered fantastic returns over a long period of time. So I would say the problems will keep emerging, so does the opportunities will keep presenting. And I think on the whole, if one has a long-term view, then I think the one is bound to probably get returns which are closer to the corporate earnings growth and the ROC which the pack of the companies are delivering. Now, very specifically on some of the opportunities and the risk which you spoke about, yes, I think from the near-term perspective, there are some amount of risk which are manifesting itself. One is the growth itself, which is sort of moderating more from the rural side of the economy. Then we have the inflationary-led challenges, which is leading to margin pressure across various companies, is what we have seen. So I think some of these and the macro picture is also becoming more adverse, which was very conducive till last year. When I say that, it actually means that the global inflation, interest rate, US withdrawing the quantitative easing and all of that. So I think those risks, the liquidity risks, are sort of emerging. So I would say one needs to exercise a bit of a caution, especially coming from such high levels of valuations, and looking at some of these headwinds. The near term is a bit more cautionary, is what I would sort of try to guide. And but that also for the long term investors becomes an opportunity, because for the long term investors, volatility is a friend, is what I have seen. So I think over the next 6-7 months is when the picture will become slightly clearer. I think till then the volatility may continue, and that's where one needs to sort of have some bit of more caution in their mind.
Absolutely. And over the long period of time, it always helps to zoom out, right, Vinit? To look at the long period rather than focus on just a couple of months. I'm looking at the makeup of the small cap fund, and I see that you have a substantial allocation towards the consumer cyclical space. Is that incidental, or is that a tactical approach in terms of the companies that you've invested in?
So see, again, considering the how the long-term trends are changing as far as India is concerned, I think we are as an economy going from a $2,000 per capita to 3,000 and then beyond, and there is a clear case as the prospects of the economy keeps becoming better, as the urbanization picks up, the income level goes up. The consumption upgradation is something which keeps happening. So keeping that aspect at the core when we are thinking from our small cap fund perspective and a long-term view, I think we believe that consumption as a category should do well over long term, and we are trying to look at companies which are leading companies within these categories, while they are small caps, but they are leading companies in their own segments. And also sort of what we are focusing on through these consumer companies are more categories where these companies are catering with a small ticket of their product prices. So I think the small ticket is something which also tends to get less impacted in case of a slowdown, and which is where we believe that having a good consumption basket should do well to the portfolio over the long term, is what we believe.
Okay, that's fair enough. And in fact, a lot of these companies are able to pass on costs through grammage, right? I'm also looking at your mid-cap basket, and I see an allocation that is more or less even Stevens in terms of sectoral allocation between basic materials, consumer cyclicals, financial services, as well as industrials. But technology is missing. IT is missing. Is that a question of valuations, or do you think that the frontline companies are more suited to carry the growth forward?
Sure. So, at the moment, you're right. It is to do with the valuations of the mid-cap IT space, which is sort of keeping us a bit away from that category right now. At the same time, we are also seeing some bit of rationalization of valuation taking place. So we are keeping our eyes open, and at a reasonable level of valuations, let's say we may be open to look at some of these names as well. So we used to have slightly more exposure to mid-cap IT just before the last portfolio, which is what you can see. But we have cut some bit of that exposure given the hyper valuations which the mid-cap IT sector has seen. And also your second point, I would imagine that right now the large cap IT is relatively looking much better in terms of the valuations, while both the segments are seeing good opportunities when it comes to the deal wins and the demand. So on the demand, we are not worried. We believe that the sector has legs for growth. The demand momentum should sustain over the next 3 to 4 years. It is just at what valuations one is comfortable to sort of own it in the portfolio is what we are thinking about.
Vinit, I'm curious in terms of how you're seeing, and this is the context that we're in, right? You're talking about a green hydrogen policy, you're talking about renewable energy getting focus. Do you think that it'll take a long time to pan out, or do you think that now would be the time to look for companies that will benefit from this shift towards renewable, towards green technology?
I think a lot of work has already started happening in terms of the execution. When we are looking at some of the engineering companies which would benefit from these changes which are taking place, we are seeing that the companies have already started seeing order inflows in some of these categories. So I would imagine that the momentum will only keep becoming stronger as we go forward. While these are all decadal changes like you mentioned, but I think the momentum has picked up. That is a good thing to think about. Some of these segments are going to would mean a lot of bigger changes which will happen in India, and this would also mean big opportunities for companies which are directly and indirectly catering to these businesses. So I would say that the green shoots are already being seen. We are also looking at companies which could be beneficiary of these changes, direct or indirect. And as a hedge, what we are also trying to do is that look for companies which are not just focusing on these categories only, but they also have their core other business which comes as a support if some of these tends to get delayed. So I think the opportunity is huge. The momentum has started picking up now. It will gather more velocity as we go on. And I think the opportunity is will be there for a long period of time.
So a couple more questions on the funds that you manage, Vinit, and in the Focus Fund. So the DSP Focus Fund allows you to have a kind of a shifting allocation, right? And as I understand it, you've shifted more towards large cap over the last several months, right? Is that indicative of the approach that you have to the current scenario where you see a lot more volatility on the horizon? And when do you anticipate that could shift a little bit more towards the value picture?
No, so actually, to be very frank, Alex, we have raised some bit of the mid-cap holding, not to a very high levels right now, because because of the bit of that cautionary view which we have. Also, the small caps and mid caps have become more expensive than their long-term averages. So we are also slightly more graded in terms of how to look at these mid caps and the small caps. So while we have marginally increased our mid cap exposure, but let's say if the opportunity so presents because of the market volatility, we will be open to increasing the weightages of the mid cap slightly more, because of a view that some of these companies which are, let's say, able to outgrow their category then should be in a better position to deliver outperformance. So I think while we it's a diversified fund, we have freedom to choose from both the categories. I think on the whole, what we want to look at even within the large caps are the alpha opportunities which are present, companies which can outgrow, companies which are reasonably placed in terms of valuations. And that is what actually you will see when it comes to the focus fund. Most of the companies we have very high active weight on, and we believe that most of the companies does present a good alpha opportunity over the next 2 to 3 years.
Absolutely. Thank you so much, Vinit, for taking the time, for joining us. And I'm sure that your investors have benefited greatly from this because they will understand how you operate better.
Thank you, Alex.